Some prominent billionaires are recently making headlines regarding the economy. Jeff Bezos just warned all Americans not to buy big ticket items if they are not needed. Yes, the father of retail himself, Jeff Bezos, is warning Americans not to buy things such as cars, refrigerators, TVs, etc., even as holiday sales are projected to be around $960.4 billion. And Michael Burry of Big Short fame just said, "You have no idea how short I am," talking about not his height, obviously, but how short he is on the markets. Now, as the stock market has been recently rallying, we see a drop in CPI and PPI. Why are these billionaires still sending warning shots about the economy? Well, because all of the recession indicators are still running really hot, hotter than they were even before, I might add. And in this video, I'm going to give you two critical charts that you need to watch right now if you care about your money and your portfolios, because these charts specifically relate to what happens after a Fed pivot. The market has been rallying recently because of a drop in CPI, a drop in PPI. So the expectation is that the Fed is going to go soft on December. But to me, we're in false hope territory. This is a classic bear market rally. And what happens after the Fed actually pivots is kind of scary. And further to that, James Bullard, as well as some other Fed presidents, are talking about no indications of a slowdown in December, not to expect a slowdown, and the risk of actually slowing too early is much higher than the risk of over tightening. So we'll get into all of this. I'll show you the two charts after the intro, and of course, we will get into some potential plays on how to play this. Hint, it's likely going to be in the bond market, just like the last time we played the 2-year note futures that I highlighted to you in a previous video, as well as on Twitter. We actually made over $12,000 on that play. That position has been closed and the 2-year notes have been climbing in yields. However, I do think that there is another play coming up on treasuries, and I will share what I'm thinking with you towards the end of the video, so you definitely want to stick around. Also, be sure to follow me on Twitter and Instagram as I post free daily financial content and give a lot of trade ideas on both of those platforms as well. You don't want to miss it. Without further ado, let's get right into it. So earlier this week, Fed President James Bullard hinted that the Fed funds rate could reach as high as 7% next year. 7% is way higher than expectations. The market was first expecting 5%, and then there were talks of potentially 6%, and now he's saying it can go as high as 7%. This is called the terminal rate, or the rate at which the Fed is going to stop hiking. 7% is much higher than expected. But even if the Fed pivots, there are two critical charts that we have to pay attention to that showcase what actually happens when the Fed pivots. It is not a rosy picture. So the expectation that a Fed might pivot, even though in my view it is a false expectation, this could get the market to rally in the interim. But what happens when the Fed actually pivots is a lot scarier than this. So this right here is a chart from ChartStorm. It goes over the last few tightening cycles from the Fed and what actually happened. This bar right here in the red is when the tightening actually was accelerating, and the green is when tightening was decelerating or slowing down. We are now entering the green territory after 4 back-to-back 75 basis point rate hikes. It doesn't mean that the Fed is going to stop, but most of the front loading has been done. And you know how there's that delayed effect that we always talk about with the Fed rate hikes, how it takes a long time for it to hit the economy? Well, this right here is testament to it. Look at the 12-month forward earnings per share drawdowns as the US Fed tightening actually halts. So we get into a tightening accelerating cycle. The forward EPS is still high. As we near the green, we start getting a drop. The green meaning a tightening deceleration moment. And then after the Fed stops tightening, we get a 12-month forward EPS drawdown, the largest drawdowns in 12-month forward EPS. This is likely because the Fed does not stop hiking until the rate hikes actually hit the economy. Unemployment goes up. Stock valuations go down, things get way more expensive for businesses, and it finally has an effect on their earnings. And we are seeing now the first effects, really just this last earnings cycle, the first effects on a lot of mega cap tech companies, for instance, and all the layoffs that they are announcing. But we still have not yet seen the majority of the EPS drawdowns. We're just starting to scratch the surface. So there's a lot more earnings compression to go. And here's the second critical chart that I wanted to share with you. I've shared this before. I've also shared this on Twitter. But what happens actually after a Fed pivot? This red here is the S&P 500. The S&P 500 actually tanks after a Fed pivot. This is likely because by the time the Fed pivots, again, the rate hikes and their tightening cycles have already taken place and have affected the economy already. The Fed is not going to pivot before the rate hikes do their job. So all of this talk of a premature pivot or a premature slowdown really is just fueling a bear market rally here for the smart money to dump on the dumb money who are going to be buying at the highs of this rally. As I stated on Twitter on that day that we had that huge 5% run up, if today was the day that you chose to buy stocks, you should probably think of the market differently. Start trying to think of the market differently. Smart money sells on days like that, not buys. But what these two charts represent is that there's actually a long time to go before the Fed actually halts and before what they are planning to do takes shape and reflects in the economy itself. The bear market has never bottomed while the Fed was still hiking, never in a rate hiking cycle. So if you guys are fans of this channel and you guys are fans of TA Tuesday, TA Thursday, you know that I highlighted this area weeks ago. This is the area where the resistance line of the descending wedge meets the golden pocket. And this is where I plan to open up a major short on the S&P 500 as well as the NASDAQ. Now, it's not going to be automatic. It really will depend on what's going on in the economic landscape, what new data points we have coming out. If we actually get to this level, do we break through this level, etc. A lot will determine on when I actually open them. But that is the next time that I will likely open a huge short position, just as we did back here in August. Again, for those of you that are fans of this channel. But if you want the actual play-by-play, when I do it and what exactly, how I will choose to short the markets, if we get to that level, sign up to the Academy. Link is in the description below. We are actually running a Black Friday promo that is starting early. We've never done this before, 25% off of our annual and lifetime memberships. We will likely not do this for a very long time, if ever again, because we feel like the Academy is fairly priced, to be honest. You get access to the day trading course, the options course, the chats with thousands of traders, the analysis, the updates, the play-by-plays, the stocks, options, and futures trade ideas. You also get access to the Zoom calls with me, where you get to ask me any question you want about trading, options, futures, about strategy. And this is the same Academy where I had that $12,000 trade on the 2-year Treasury note futures. And as I said, I'm going to give you a general trade idea on how I'm going to be playing bonds towards the end of the video. So be sure to take advantage of that Black Friday 25% off, because we're likely not going to see that for a very long time. Okay, so aside from those two critical charts, one other thing I have to share with you is the spread between the 10-year and 2-year Treasury notes. Right now, this yield curve is heavily inverted, more so than any other time going back to 1981. This is not a coincidence, because 1981 was the last time that we saw inflation like this. And as you know, if you've been watching this channel, we have never hit an inverted yield curve on the 10-year and 2-year or the 10-year and 3-month and not had a recession. So right now, this yield curve is inverted by minus 0.66. We didn't even have to invert that heavy back in 1989 or back in 2000 or even back in 2008 for us to hit a recession. But again, this to me is more like the early 1980s, the last time that we had inflation like this. So if this yield curve continues, we will likely see a recession very soon. That is part of the reason why Jeff Bezos as well as Michael Burry are still sending warning shots about the market, even though the retail traders are celebrating this rally as if this is the bottom. To me, the only way that this rally continues is if the Fed actually surprisingly comes in and pauses or pivots very soon, which I don't think is going to happen, especially as retail sales jumped in October, which goes against what the Fed actually wants. Unemployment is still very low. That needs to go up some more. And even though everyone is celebrating a 7.7% inflation rate, that ironically, that same exact rate is actually what tanked the market in the beginning of the year when inflation came in at 7.7%. That is what started the tanking of 2022. So the moral of the story is actually twofold. One, don't fight the Fed. And two, a Fed pivot doesn't actually bring about an immediate bull market. As a matter of fact, that is when the market tends to crash further and find new lows. Now, before we go, as I promised, I said I will give you a trade idea on treasuries. Here, let's take a look at what happens to the 2-year treasury yield after the Fed actually pivots. After the Fed pivots, the 2-year treasury yield tanks like a rock. Now, remember the inverse relationship between yields and prices. So when the 2-year treasury yield tanks, 2-year bond prices go up. And when that happens, my friends, the gains will be a lot more than what we made on just the small 0.63% move in 2-year Treasury notes right after the inflation report came in lower than expected. If the 2-year Treasury yield tanks like a rock, just like it did after every single Fed pivot going back to 1988, that will be one of the easiest plays in my opinion. Much easier than trying to time the stock market with what the Fed is doing, because what the Fed does directly affects bond yield, and bond yields is what affects the stock market. That is why we always say the bond market is a much better predictor of the economy than the stock market. And it's the one that reacts the quickest to what goes on with the Fed. And then that trickles down through to the stock market and the rest of the economy. So anyway, traders, that is it for this video. Remember, 25% off for Black Friday. Check that link in the description. You will want to take advantage of this because you might not see this for another year, if ever. Leave a comment down below. Let me know what you think of the market. Are we on the cusp of a bear market rally? Have we actually found the bottom? Do you think the market will tank further? How much do you think it will tank? Are you guys going short, long? I would love to know your plays and your opinions. Leave it in the comment section below. If you got anything out of this video, leave it a big fat thumbs up just like this. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.